Today we are discussing Fidelity National Information Services, ticker FIS. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. Market cap is $43.8 billion, enterprise value of $55 billion. So you see about $12 billion in net debt on this business. It's quite a significant amount, about 20% of our enterprise value, operating in the IT services industry, which tends to be pretty good. They provide technology solutions for merchants, banks, and capital markets firms worldwide. Has a merchant solution, banking solution, and capital market solutions segment. They have enterprise acquiring, software-led, small business acquiring. Banking has core processing, which is a very good business. Very high quality business in the core processing industry. Fraud, risk management, compliance solution. And capital markets offers securities processing, finance, global trading, asset management, and insurance company. So this is a really interesting area of operations. The beta of 0.86 is a key indicator here that this might be a high quality business, because the lower the beta in the S&P 500, the better the sign is of a low volatility stock. So it tends to be something that I find very attractive. Now, the return on invested capital, first thing I see here is you have 20 straight years of profits. Anytime you have 20 straight years of profits, it immediately jumps up as a potentially high quality business. Now, second thing I see here that leaps out is you've kind of had a decline in the overall asset performance, return on invested capital performance since the early 2000s. So you're in this 20% plus range, 2004 and before, and then you drop down to 10% in 2005, and it's been below that 10% range ever since. Now, there's a lot of reasons that could happen. It could be an increase in acquisitions, could be goodwill, various things like that, causing a relatively high in capital in terms of the assets without really talking about true, tangible assets. So one thing we're going to do is we're going to go into the balance sheet and look at those tangible assets, see what that is later in the video, and see how that really plays out. But you can clearly see something that's very attractive here, which is low volatility from year to year. You have 2011, 3.99%, 2012, 4%, 4.35%, very little change year to year. And on a normalized basis, this tends to slowly, it looks like steadily increase each year, which tends to be a good sign. And then you could have stuff like investments that are lowering it a little bit after that. But overall, very, very stable. And that stability is something you definitely want to look for in a business to be a high quality indicator. Now, what I don't like as much about it is that these numbers are relatively low, 5, 6, 6%, 3%. These are lower than what I would normally like, because when you look at this 10-year median return average, you see 3.9% return on invested capital. I really would like this to be 10% plus. Return on equity of 7%, would really like that to be 15% plus. However, I mentioned core processing is a very, very good business. I have a feeling something's going on here in the balance sheet to making these numbers look worse than they are. And another reason you can think that is you look at this PE ratio of 46 is telling you that the market doesn't really agree that this is a bad business. The market's saying, hey, this is a business you want to pay up for. This is a business that's worth a very high PE ratio. So it's something to take into account there. Likewise, when we look at this revenue growth of 9.4%, that's a good number, right around 10%. When you're hitting a 10% growth rate in revenue, that's a good sign. Free cash flow growing at 15% a year, also a very good sign. Now, what could be driving these lower returns is when you see something like asset growing at 20% a year. 20% is a very high level of asset growth, not something I normally would want to see, especially when this asset growth is much higher than all of your returns on capital. That can really lead to these lowering returns on invested capital over time. We're going to have to dive into that. Likewise, we see earnings are actually down over the last decade from $1.55 in 2012 to 67 cents in 2021. So we need to understand, is that real? What's going on there? Because when you look at 2017, 2018, you're seeing a $3.75 number, $2.55 number. So clearly they have the ability to earn a lot of money. Likewise, although they're reporting earnings per share from 2019 to 2021 of 66 cents, 25 cents, and 67 cents, you can clearly see they're doing much, much better than that, because they were confident enough to pay out a dividend of $1.40, $1.40, and $1.56. How do you pay out dividends much higher than your earnings? Well, it could be because something is distorting the overall earnings picture here, which isn't truly driving the results in the business. So something to be aware of, that this number might not be fully accurate. So we're going to have to do a deep dive into that accounting, which starts right after this. But if you're enjoying it so far, please consider hitting that like button. And before the end of the video, I'm going to try and convince you to become a subscriber, because I want to add as much value as possible to you as an investor. So let's dive into the income statement next. So First thing I want to see is you can see the revenue, close to tripling, but the gross profit definitely did triple. So your gross profit's growing a little bit faster than revenue, showing a little bit of incremental operating leverage there. Now, the big difference is, of course, your SG&A is growing very, very fast. You've gone from $763 million to $4 billion. So your SG&A has more than 4x'd over the course of the decade, which is very significant, actually 5x'd over the course of a decade. So that's getting you some negative operating leverage there because your operating profit has only gone from $1 billion to $1.5 billion. Likewise, our net income is going from 461, but in 2021 to 417, so basically flat over the course of that time. Now, something actually really interesting is happening here. You can see a huge increase in the dilution of shares. You start out at 298 million. It looks like you bought back shares for 4 years here from 2012 to 2015, but then it jumped by 10% or by 15% in 2016, and it continued to grow a little bit, and you bought back shares for 2 years, jumped by 50% in 2019, dropped by another 50% in 2020. So this is suggesting to me that there's either some big sort of acquisitions or some sort of financial problems in the business that were having to be addressed with massive dilution on this piece. Most likely, though, because of the type of business they're in, I'm going to guess it's acquisitions, and we'll be able to see that on our cash flow statement a little bit more, and also on the balance sheet, which we're going to go to next. So balance sheet. First thing we can see here to determine acquisition. So this is what's really interesting, and this is why I said it's not really a problem of tangible assets. You begin the decade with 415 million in tangible assets of this PP&E. 415 million PP&E. Let's go back to the income statement, and they earned 461 in net income. So what that's telling you is there's over 100% return on your tangible assets in 2012. Now let's go to 2021. And we're going to compare that as well. So 2020, you had $1.4 billion in PP&E in 2020, or $1.4 billion of PP&E in 2021. Income statement, $400 million. So now you're saying, okay, maybe it's only a 30% return on tangible assets today, but still 100%, 30%, these are very, very good numbers. So what's the big difference here? And the big difference in terms of our reported returns are our assets, which is driven almost entirely by goodwill and intangible assets. You can see you started the decade with $10 billion in intangibles between goodwill and intangibles. You're ending the decade with $68 billion in intangible assets between goodwill and intangibles. This comes about from acquisitions. You're seeing a big acquisition here in 2018, 2019, and that's driving a huge jump in both your intangible assets and your goodwill. You had this other acquisition in 2014, 2015. Of course, that's relating very closely to these dilution events, which we see here, and that's driving the big increase in shares outstanding. So normally I would see this number of shares outstanding and say, hey, this is just completely unacceptable to be this much of a dilution rate, but it would be understandable if you needed to issue those shares to grow. The problem that's tough is they issued shares at a very high rate because you actually forced a massive amount of dilution into this business for basically goodwill. They weren't acquiring many tangible assets, and we have yet to see really the impact on the bottom line from that. I mean, you now have $83 billion in assets against earnings of only 417 million. This is actually a terrible return on capital, which is what you're seeing here with this below 1% number. So how do I short that as a shareholder? Well, the underlying business is actually turning a very strong return on your tangible assets, and that's what matters in terms of a business analyst perspective. If we're analyzing the business, this is a very high quality business. Your return as a shareholder on your PP&E and your accounts receivable and other current assets is actually very, very good. There's no inventory in this business. You're basically operating very low number of assets for a very high return on those assets. The problem is in addition to being a business analyst, we also need to be an analyst of the management team and their capital allocation decisions. And so far, what the capital allocation decisions are showing us is that the management is making a mistake on these capital allocation because they're overspending on these acquisitions. They spent at least $40 billion on this acquisition, $60 billion from what I'm seeing here on an acquisition that has not increased their income. They've not increased the income. They're not increasing their operating profit with these acquisitions. So why is that? What's going on? Now, it could be that that's going to take place in the future. There were some one-time costs and that plays into it. Fine, whatever. But just this is a huge acquisition. When you think about their revenue is $14 billion, they're spending 3 or 4 times their revenue from before the acquisition on this acquisition, substantially more than their net income. Very big acquisition in order to make this growth plan, and it's not yet played out. So I don't like seeing a $60 billion acquisition here that's really based in goodwill, but hasn't been able to flow through the balance sheet to the income statement. Likewise, we've seen our debt triple over the course of the decade. We're not seeing our EPS triple yet. That would be a concern. And so I'm not liking the capital allocation, despite this being an amazing business from the actual returns on tangible capital. So in our cash flow statement, we can see that they did pay some cash as well for this acquisition, $6.5 billion, in addition to the dilution from the common stock. They had to issue this debt, $8.6 billion here. You can see the big debt intake in that 2019 timeframe in order to pull that off. Not uncommon there. You can see the other acquisition, of course, in 2015. They had to take on debt to do that. I don't really like that this way of doing your capital allocation. I mean, your cash flow from operations is way higher than your net income. I mean, look at this is actually extremely significant. $4.4 billion in cash flow from operations in 2020, 164 net income. So this is massive depreciation and amortization. Are they depreciating the goodwill? No, I mean, so they are depreciating this other intangible assets. So that's playing a lot into why their net income numbers are so low. What it means is these returns on cash flow from operations are just even more. I mean, think about the cash that this business is generating, $4.8 billion on tangible assets of $1.4 billion. They're getting a 300% return on their cash flow from operations against the net tangible assets. Again, an amazing business, but the way the accounting works is making their numbers look very, very poor. And so this is really taking into account paying off past spending and everything playing into these numbers. It's why you have such high depreciation and amortization here. It's not uncommon that you would see something like that, but it is something to be aware of why those numbers are playing out the way they are. It does mean, of course, cash is what matters. And so if you're evaluating this business, you really care about the cash flow. You're seeing this $4.8 billion. And if you're not having to actually reinvest that, then $4.8 billion in earnings against a market cap of $43 billion means you're getting maybe a 10% yield on those numbers, and that can actually be a very strong performance. So I think what I'm getting from this is this really requires a lot of additional work to understand like what we're doing here. I mean, let's go to the balance sheet. Do they buy back any shares? Income statement. Have they bought back any shares since this? They have. So you can see their shares outstanding peaked in 627, and then they bought back, 1% over the course of that next year. That's a pretty good sign that they're going to start these buybacks again, where they're buying back 1% to 2% a year. That really can help you as a shareholder. You're getting a lot of cash, and especially when you think about that cash flow being like $4.8 billion, but your gross profit was $5.1 billion. It means so much of this money is really on depreciation and amortization, and it's really converting at a very high rate here. So what you'd have to do for this business is you need to do an in-depth study of the accounting before you would consider buying it. Because what's really interesting when you go, especially like knowing some of that background now, I look at these 10-year median margins, you see a gross profit margin of 33% converting into a free cash flow margin of 19%. These are very efficient turnover of a low gross profit into a very high free cash flow margin. And that can only be achieved from very strong returns on the underlying assets, which is what they're doing. I said at the very beginning, core processing is a very good industry, and I think we do see that here in the quality of this business. You're seeing those 300% returns of your operating profit, operating cash flow on those tangible assets. So it is very, very good numbers. It could be that this acquisition is working out, but you would really need to study the 10K, go through, understand their depreciation and amortization schedule. Are those true expenses that would be repeated? If they are, this could be a very overvalued company. If they aren't, this could be in a substantially undervalued company. So I wouldn't put Fidelity National Information Services on my watch list per se. It would be more of the let's study further. Let's see what this is. This is a complex situation when you see a chart like this. There's only one reason you'd have a PE this high for business results that look like this, and it's because the business results are understating the quality of the business. They're understating the growth. They're understating the performance. And that's my gut instinct, is that Fidelity National Information Services, FIS, is actually a really good business that looks quite poor, and that could be an opportunity. So if you learned something from this video, hit that like button. Please subscribe. I think you're going to really enjoy this content if you've made it this so far. I'm working through every company in the S&P 500, and the companies that have already made my watch list are in the playlist at the top of the video. And if you'd like to use this software that I'm using, quickfs.net, the link is in the description below. That's my affiliate link. I would encourage you to use my link. It's a great way to support the channel. Thank you for listening, and until next time, stop paying fees, start building wealth.